The objective of this IAS 2, which will tell us about the determination of the cost of inventory, that is initial recognition, then subsequent recognition after the use, and then the cost formulas that are required to assign the cost to the inventories. So, what is the scope of it? What is the meaning of inventories here? Inventories include assets which are held for sale. Unlike the PPE, they are not held for sale. You buy and sell the inventory to make profit, and that is your main activity. And according to IAS 2, it includes the finished goods, it includes the work in progress and the raw material too. Inventories specifically under IAS 2 exclude some specific assets like work in progress arising under the construction contracts, the financial instruments and the biological assets, because for all these three items there is a separate accounting standards which are there, which will deal with these three items. So, therefore, other than these three items, IAS 2 applies with respect to determination of cost, determination of cost of goods sold, determination of the value of inventory and the related effect on the financial statements. The fundamental principle for the valuation of inventory is that inventory is always valued at cost or the realizable value, net realizable value. For the time being, I can use as a market value whichever is lower, unlike the PPE. PPE says that the IAS related to PPE says that PPE should be shown at the cost less accumulated depreciation or fair value less accumulated depreciation. But in this case, it is a cost or the net realizable value whichever is lower because of the conservative principle. What is this cost? Cost includes the cost of purchase, less discounts or rebates if any, plus the cost of conversions if any, and other costs required to bring the inventories to the present location. So, conceptually it is more or less same like the cost of PPEs, but in this case there is no concept of dismantling, because in this case you buy and sell the goods. However, the cost also excludes, as the standard very clearly says, the abnormal waste should not be included in that, the storage cost, so it is a separate expense, administrative overheads unrelated to the production should be shown as a separate expenses, the selling cost, foreign exchange differences should be shown separately. So, these costs are not included in these items, are not included in the definition of the cost. As I mentioned, the accounting standard talks about the determination of cost and the methods in which the cost will be assigned to the units sold. And there are two methods which the accounting standard says, that is first in first out, in short FIFO, or the weighted average. Let us take an example to understand the FIFO and the weighted average, because the FIFO and weighted average selection will have an effect on the bottom line of the company. Ultimately it is going to increase the cost of goods sold or increase the cost of inventory. So, it is an expense versus asset game played by the companies under the accounting standard 2. So, in this example, suppose the opening stock is 5,000 at the rate of 10, the purchases on 10th April and 15th April 6,000 and 2,000 at 15 and 20 respectively. But on 20th May, you are selling 10,000 units at 30. So, to determine the cost of goods sold of this 10,000, you have to decide whether you want to follow FIFO or weighted average. But will that have an effect on a profit? Answer is yes. Let us see that. Suppose if I follow FIFO, that means the first in and first out, that means I sell the goods first which I received. So, under the FIFO, I am going to sell the 5,000 at the rate of 10, then the balance 5,000 at 15. So, the cost of goods sold comes to 125,000. An unsold stock will come from 1,000 at 15 and the balance 2,000 at 20. So, as a result, I am going to have a cost of goods sold at 125 and the closing stock will be 55,000. So, COGS will become an input for income statement determination of profit. So, profit comes to 175,000. Whereas in weighted average, instead of linking it with each individual purchase, we find the weighted average, and the weighted average is, in this case, is the total value divided by the total quantity, and that comes to 13.85. So, the inventory will be valued at 10,000 into inventory will be valued at 3,000 into 1385, and the cost of goods sold will be 10,000 into 1385. And you see the cost of goods sold. In the previous case, cost of goods sold is 125,000. In this case, 138,000. So, let me put them together. If you see here, all other things remaining constant, the sales is constant, so cash flows are not affected, but the profit is differing. The difference in a profit is due to the inventory valuation. As I mentioned, COGS is an expense, inventory is an asset. So, the selection of the methods of inventory valuation will impact the amount of expense or the amount of the asset to be shown on the balance sheet and income statement respectively. As a result, the profit is going to be affected. So, the profit is a function of the methods of inventory valuation. In other words, by changing the methods from FIFO to weighted average or weighted average to FIFO, it is possible for a company to change or manage the profit. So, whenever one observes a balance sheet or an income statement and focuses attention on the profit, there is a need to question and understand the methods that they have adopted, because the methods of determination of inventory valuation will have an effect on the cost of goods sold and on the inventory. So, therefore, IAS 2 is an important accounting standard which will have an effect on the determination of profit. In the same way, like any other standard, IAS 2 also talks about the disclosure. It says mention very clearly the accounting policies for the inventories, carrying amount of those inventories, whether carried at the value, fair value or the cost to sell, the carrying amount of inventories if at all you are pledged as a liability somewhere, and also the cost of goods sold. So, IAS 2 exclusively focuses on inventory. It affects COGS and the assets shown on the balance sheet as an inventory, and it affects the profit. Thank you very much.